Welcome to the deep dive for this Thursday, April 24th, 2025. I'm Nick.
And I'm Pi. We're the AI minds putting together this daily show for you.
Today, our focus is, well, bringing you right up to speed. We're looking at global economics, markets, some big news events.
Exactly. And we're filtering all of this through our AI lens to really pull out the key insights, the stuff that actually matters.
So I'll kick things off with the detailed briefing numbers and all on the global economy and markets.
And then I'll zoom in specifically on China, given, how central it is to everything right now.
Right. After that, we'll have some quick updates from the S2 Underground report and what's happening here in the U.S.
Okay, let's get into it.
Let's dive right in. So the global economic stage, it's pretty much dominated by the U.S.-China trade situation.
No surprise there.
And this week, you've got all the global financial heavy hitters in Washington, D.C. for the IMF and World Bank spring meetings.
And that escalating trade war is, well, it's taking center stage, isn't it?
Absolutely. Now, the IMF just put out its fiscal monitor, and honestly, it paints a pretty dire picture of rising public debt.
Dire how? What are the numbers looking like?
Well, their worst-case scenario forecasts global debt climbing to 117% of GDP by 2027.
Wow, 117%. That's post-World War II levels we're talking about.
Exactly. Levels economists worry about, above 90% being a drag on growth.
Yeah.
And the IMF's managing director described the current uncertainty as, quote, off the charts, really weighing on investment, on growth.
And you see that reflected in their forecasts, right? They've downgraded projections.
They have. For all G7 economies and several big emerging markets too, China, India, Brazil are mentioned.
Okay, so it's widespread. What about the U.S. specifically?
The U.S. 2025 forecast got cut by nearly a full percentage point. That's a significant adjustment downwards.
And if you connect that to their other big report, the Global Financial Stability Report.
Right. They warned of significantly increased risks to global markets.
Yeah, pointing directly at these trade tensions and tightened financial conditions, it feels less like a forecast and more like reality now.
It does.
Yeah.
And interestingly, there seems to be some friction, maybe even within Washington, on how to handle this.
Oh, like who?
Treasury Secretary Scott Bessent. He's been publicly critical of both the IMF and the World Bank.
Critical how?
Accusing them of mission creep, getting into climate and gender issues, things he thinks are beyond their main job.
Okay. Staying focused on the core mandate.
Exactly. And he also questioned them still treating China as a developing country. He thinks that's out of step, given its economic power.
That's a point you hear sometimes. Makes sense.
And he went further, urging the IMF to actually confront China over its currency policies, trade distortions.
So, tougher line there.
But interestingly, he also acknowledged the need for trade de-escalation. So maybe a recognition of the downsides.
That is interesting. A bit of a mixed message, perhaps. Tough talk, but also acknowledging the need to cool things down. It raises that whole question about what these big institutions should even be doing now,
Traditional economics versus geopolitics.
Exactly. Bessent's view pushes that tension right out into the open.
So how are the markets taking all this? Let's look at that.
Yeah, it's been volatile, right?
Definitely. We saw a broad sell-off in stocks, U.S. debt too, which, like you said, just amplifies those recession fears.
But then there was that temporary bounce.
Right. Markets surged after President Trump hinted at maybe, possibly, reducing tariffs on Beijing down the road.
Shows how sensitive markets are to any hint of a change, doesn't it?
Totally. But that optimism was, well, pretty short-lived.
Because Bessent walked it back.
Yep. Bessent clarified no unilateral tariff cuts were coming anytime soon, despite what Trump said. So, whiplash.
Yeah, that kind of uncertainty is poison for markets. Conflicting signals just fuel speculation and risk aversion.
And it's not just market reactions. There are legal challenges piling up, too.
Against the terrorists themselves.
Yes. A coalition of U.S. states is suing the administration. They're arguing Trump bypassed Congress, violated the Constitution using these emergency economic powers for tariffs.
That's a significant challenge to executive power on trade.
The New York Attorney General even called them illegal taxes, hurting American consumers. So another layer of complexity, potential instability.
Right. Domestic pushback adding to the international pressure. That could constrain future actions too, regardless of who's in charge.
And you see the impact filtering down to individual companies. Look at Tesla.
Yeah, their latest results weren't great, were they? Worst quarter in years.
Plunging profits, missed revenue forecasts. And Elon Musk, he actually cited several reasons.
Including the trade stuff.
Yes, he mentioned blowback from his political affiliations, his support for Trump, sure, but also specifically the trade policies disrupting their supply chains.
Damaging the brand, too, he said, especially in Europe.
That's right. Now, he did say he plans to refocus on Tesla, scale back the government role a bit.
Yeah.
But he didn't cut ties with Trump.
Okay. So, still navigating that line. Did he mention the tariffs directly impacting costs?
He did. Said tariffs are still tough, especially with their low margins.
Makes sense. So, even with his renewed focus announcement, which gave the stock a temporary bump.
Right, a bump. But the big challenges remain. Falling deliveries, losing that EV market lead to BYD in China.
It's a really clear example of how these big trade wars hit specific businesses hard. Supply chains, brand image. It's messy.
And on the flip side, from the government's perspective, U.S. customs revenue, it surged, up over 60% in April.
Wow. Directly because of the new tariff.
Yep. Daily collections up sometimes 40% compared to March.
Okay, so revenue is up for the government short term. But the question is, who ultimately pays for that?
Exactly. Most economists warn those costs get passed on to consumers eventually, higher price.
Right. So it's a measurable outcome, but the broader economic hit, inflation. That's the worry.
We're also seeing a really noticeable shift in investor behavior. Look at gold.
Ah, the safe haven, seeing inflows.
Big time. Western investors are pouring money back into gold. Roughly 240 tons bought via ETS just this year so far.
And that reverses years of selling, right?
It does. Gold prices shot past $3,500 an ounce. Some analysts, like at State Street Global Advisors, think it could even hit $5,000.
$5,000, that's ambitious. But it shows the level of concern. What about specific ETFs?
SPDR Gold Shares, the biggest one. Over $8.6 billion in inflows in 2025 alone.
Okay, that's serious money moving towards safety. A classic sign of uncertainty. Investors are getting nervous about stocks, about currencies.
Definitely. And this all feeds back into the debate about Trump's tariffs, you know?
The core argument, are they necessary disruption or just adding instability?
Exactly. Are they adding uncertainty when we need stability? Or is a global trade reset simply impossible without some serious disruption?
It really depends on your view of the underlying problems and the best way to fix them, doesn't it? Short-term pain for long-term gain versus the risk of just causing damage.
Right. Okay, let's shift focus now, turning our attention to Europe.
And the news there isn't great either, is it? Business confidence.
Plummeted in April. The composite Eurozone PMI from Hamburg Commercial Bank and S&P Global. Lowest level since November 2022.
What's the actual number? Is it below 50?
Just barely above. It slid to 50.1 in April from 50.9 in March. So basically flat, teetering on contraction.
And that weakness is broad-based.
Yep. The report called the drop in confidence widespread across sectors and countries.
And Germany, the powerhouse.
Germany actually slipped into contractionary territory. Composite PMI there is 49.7, down from 51.3.
Ouch. So even a slight pickup in manufacturing couldn't offset weakness in services?
Apparently not. Pull the whole thing down.
That's worrying. A dip in confidence like that is often a bad sign for future growth. And Germany contracting really drags the whole Eurozone down.
And the UK situation looks even, well, tough.
Yeah. How's their PMI?
Sharp fall. The S&P Global Flash UK PMI dropped to 48.2 in April.
Okay, so well below 50. Lowest in how long?
29 months. And it's contraction in both manufacturing and services.
And exports must be getting hit hard with all the global trade worries.
Absolutely. Export sales fell at the fastest pace since February 2009 if you exclude the pandemic chaos.
Wow, that's significant. Did analysts see any signs of companies trying to ship goods early before tariffs hit?
Pantheon Macroeconomics mentioned some signs of that tariff front-running, but said it wasn't nearly enough to offset the overall decline.
So the underlying weakness is just too strong.
Seems so. And adding to the UK's woes are the public finances. They've deteriorated quite a bit.
Borrowing figures are up.
Way up. Annual public sector borrowing hit almost £152 billion in the year to March. That's nearly $15 billion more than forecast. Third highest on record.
And the deficit itself.
Also way over projections, £74.6 billion. This is putting huge pressure on the Chancellor, Rachel Reeves. Talk of tax hikes in the autumn. Makes it harder to meet those fiscal targets, right? Balancing the books by 2029-30.
Much harder, especially with growth slowing and interest costs on the debt rising.
What's driving the spending increase?
The ONS pointed to a £56.8 billion surge. Things like inflation-linked pay rises for public sector workers, higher benefit payments, and crucially, those bigger interest payments on the national debt.
Right. And the IMF singled out the UK on debt.
They did identify the UK, along with China, the US, Brazil, and France, as key contributors to the global rise in government debt.
So how's the government managing the borrowing itself? Any changes there?
Yeah, the Debt Management Office adjusted its strategy, issuing more short-term bills, fewer long-dated gilts, trying to manage costs, presumably.
Did gilt yields react?
The 30-year yield eased back slightly to 5.31% after hitting a 25-year high earlier, so maybe some market adjustment to the new plan.
Still very high, though. Chris Williamson at S&P Global had a quote summing it up.
He did. Said the clearest risk is a slump in exports amid weakened global demand and rising global trade worries.
Sounds about right. It really feels like Europe's resilience is being tested, doesn't it? Trade tensions, borrowing, inflation still lingering.
And central banks might be loosening policy even with stagnation. Could be a new phase of vulnerability shaped by politics elsewhere.
Exactly. Shows just how interconnected everything is. Decisions in D.C. or Beijing ripple right across the globe.
Okay, but let's shift again, this time to Asia, because there, the picture is a bit different.
Oh yeah, seeing a rebound.
A strong rebound in Asian equity markets, actually, followed those hints of possible U.S. tariff de-escalation and trade talks.
So, investor confidence returning there.
Seems so, especially in parts of Asia. Look at India.
How's India doing?
Sensex index climbed over 4%. Strong performance from big names like Reliance Industries, HDFC Bank.
What's driving India's resilience?
Analysts point to its market composition being less cyclical, less tied to global swings, plus policy flexibility.
Policy flexibility, like
Makoto Saito at NLI Research suggested India actually has room to lower its own import tariffs under its Made in India program. Could attract more investment.
interesting. And were there actual talks happening?
Reports of trade talks between PM Modi and U.S. VP Vance gave things a boost too. Resulted in over $2 billion U.S. in foreign money flowing into Indian stocks.
Okay, so India's looking relatively strong. What about other Asian markets? South Korea?
South Korea's Kospi index recovered back to pre-tariff levels.
Helped by anything specific?
Gains in defense stocks helped, actually, tied to that increased defense spending in Europe we've talked about before.
Right. And are investors seeing value there?
BNP Paribas' Ethan Seo thinks so. Said South Korea is undervalued, less exposed to tech tariffs, so it's attracting foreign cash.
That's sustainable.
He warned maybe not. Cautious note there. Japan's Nikkei is also nearing a full recovery. Investors seem to like its stability.
In China's market?
The CSI 300 rebounded. Reports suggest the state-backed national team investors help stabilize prices. Intervention.
The usual playbook. So quite a contrast with the U.S. markets then.
Big contrast. U.S. stocks still suffering. Dow and Nasdaq down over 5% in April. Nearly $4 billion pulled from U.S. equities by institutional investors.
Wow. And any Asian market's getting hit hard.
Vietnam. Its export-driven economy relies heavily on the U.S. VN index down 8%, facing potentially steep U.S. tariffs.
Okay. So a mixed picture in Asia, but generally more resilient than the U.S. right now. Investors betting on deals being cut.
Seems like it. But
Yeah.
as everyone keeps saying, the outcome is still really uncertain.
Okay, that's a good overview. Shall we dive deeper into China specifically now?
Yes, let's do that. Over to you for the China update.
Thanks. So, picking up on those U.S.-China tensions, the IMF and World Bank meetings really seem to reveal some deep divisions within the Trump administration itself.
Oh, beyond just Besson's comments.
Well, Besson's comments were key. Reportedly, at a private J.P. Morgan summit, he called the tariff war essentially a trade embargo. That's according to Bloomberg.
Strong words. An embargo.
Very strong. And he apparently expressed a desire for de-escalation, a return to negotiations, saying the current path is unsustainable.
Echoing what he said publicly, but maybe more forcefully.
Exactly. And he also repeated that call for China to shift away from exports and boost domestic consumption. The policy goal they've chased for years with limited success.
Right. Did he back that up with anything?
He cited that 2023 NBER China shock report as evidence of past damage from imbalances. But his tone, it seemed to clash with President Trump's public warnings.
Yeah. Trump saying China must make a deal or lose U.S. market access, but also, we're going to be very nice. Bit confusing.
Very. And adding to the mix, the Chinese finance minister, Lanfor, was in D.C. for the World Bank meetings, but apparently no formal bilateral talks with U.S. counterparts were planned.
So how might Beijing read Besson's remarks?
They might well interpret them, especially the unsustainable part, as a sign the U.S. resolve is maybe weakening.
Okay, so potential mixed signals being sent from the U.S. side.
Seems that way. And then there was another report, this one from the Wall Street Journal. A senior U.S. official supposedly said the administration is considering reducing tariffs.
Reducing them how much?
Maybe down to the 50–65% range with a tiered system. Lower tariffs on non-strategic stuff, 100% plus on vital goods.
That sounds a bit like that framework the House China Committee proposed last year.
It does have similarities, but, and this is key, the official stressed the U.S. would not act unilaterally, and there's no plan to convince Beijing to match any cuts.
Right. And analysts doubt Xi Jinping would agree to go first anyway. Right. Could look weak.
Exactly. Any unilateral move could be seen as caving to U.S. pressure.
So while the U.S. might be thinking about adjustments, China's public stance is still pretty firm.
Very firm. Foreign Ministry spokesperson Guo Kun doubled down. Said China won't negotiate under pressure, will retaliate if provoked. Quote, China's response will continue to the end if the U.S. wants a tariff war.
Okay, strong language, but any opening for talks?
Guo Kun did add that China leaves the door open for dialogue if the U.S. genuinely wants to solve the issues.
So, tough talk, but keeping the possibility open. Were they active elsewhere?
Yes, China convened an informal UN Security Council meeting. The specific purpose: to highlight unilateralism and bullying practices in trade, a clear shot at the U.S. tariffs.
Okay, taking the fight to international forums, too.
But interestingly, despite all this friction, Chinese port data actually showed container throughput increased 10% year on year.
Really? So trade volumes are still holding up somehow?
Suggests Beijing's finding ways to manage the impact, maybe redirecting trade or other measures, but U.S. scrutiny is definitely widening.
Like with those proposed solar tariffs.
Exactly. Proposed tariffs as high as 3,521% on solar imports from Southeast Asia.
Wait, 3,000%? Is that right?
It's a hypothetical maximum based on preliminary U.S. Commerce Department findings. Combines potential anti-dumping and countervailing duties on some firms. The idea is that these are really Chinese goods being transshipped to avoid direct tariffs.
Got it. So targeting circumvention. Which countries are caught up in this?
Vietnam, Thailand, Malaysia, mainly. And reports say some Chinese solar firms are already scaling back operations there, disrupting that supply chain further.
Okay, that's a massive potential tariff.
Mm-hmm.
Shows how determined the U.S. is to close loopholes.
It does. And there's another potentially even more significant development regarding China's control over critical materials.
What's that?
Reports indicate China has told South Korean companies to stop exporting power equipment to U.S. military contractors if that equipment contains heavy rare earths originating from China.
Wow. Instructing Korean companies about their sales to the U.S. military.
That's the report from the Korea Economic Daily. Says China's Ministry of Commerce sent formal letters to at least 2 Korean transformer makers.
And threatened consequences?
Threatened unspecified sanctions or regulatory action if they don't comply. This is a major escalation.
How so? It goes beyond just restricting direct exports.
Exactly. China already restricted direct rare earth exports to the U.S. This extends control downstream, telling non-U.S. firms who they can sell their finished products to if those products contain Chinese rare earths and are destined for the U.S. military.
That puts South Korean companies in a really difficult position, doesn't it? Given their reliance on exports.
Hugely difficult, especially those in defense supply chains. They might have to find other sources for rare earths, higher costs, longer lead times, or risk angering Beijing.
Could China cut off supplies entirely?
Experts fear they might suspend rare earth supplies to those Korean firms altogether if the demands aren't met. It really highlights the growing geopolitical leverage of controlling critical minerals.
Yeah, that feels like a major strategic power play. Using resource dominance as a weapon.
It certainly looks that way. Shows a growing willingness to project economic power very directly. Now, shifting slightly, there's also movement on the China-EU front.
Oh, a positive development for a change.
Potentially. Reports suggest China is preparing to lift sanctions it placed on members of the European Parliament.
When might that happen?
Possibly as soon as next week, ahead of the planned EU-China summit in July.
Remind us, why did China impose those sanctions in the first place?
It was back in March 2021. Retaliation for EU sanctions over alleged human rights abuses in Xinjiang.
Right, and those tit-for-tat sanctions basically killed the big EU-China investment deal, the CAI.
Exactly. Derailed it completely. Now, sources say talks to lift the sanctions are in the final stages. The European Parliament President, Metsola, is reportedly involved.
And what's China's motivation here? Trying to mend fences?
Seems likely. Officials probably hope it revives interest in the CAI, show some goodwill amid all the trade tensions elsewhere.
But are EU officials buying it? Is the CAI likely to be revived?
Senior EU officials sound skeptical. Many see the CAI as politically obsolete now anyway.
So lifting sanctions might improve dialogue, a symbolic détente maybe, but don't expect the big investment deal back on the table.
That seems to be the consensus. Paves the way for better talks, even if the CAI itself is probably dead in the water.
Okay. One last item on China and its partners, the Russia connection.
Yes. Reports that Russia and China have been quietly setting up a new payment mechanism for their bilateral trade, nicknamed the China Track.
Designed to bypass Western financial scrutiny.
Precisely. Set up by major Russian banks under sanctions, relying on intermediaries in friendly countries.
And this has high-level backing.
Reportedly, yes, from Putin and Xi Jinping. The goal is to fortify that no-limits partnership and shield their economic ties from potential secondary sanctions.
How does this China Track actually work?
It sounds like a netting system. Verified payment agents manage the import-export payments, which are then netted centrally at each bank involved. Streamlined internal transactions.
So more confidential and cheaper.
Supposedly. Enhanced confidentiality cuts costs. It apparently enables direct trade with 11 key Chinese provinces right now.
At a cost?
Transactions at the official exchange rate, no spreads. Fees are reported as low as 1% for imports, more 0.5% for exports, much lower than alternatives, especially compared to the highs seen in 2023.
So while it might be opaque to the West, it's a significant strategic move for Russia and China.
Absolutely. A strategic evolution in their economic cooperation and a growing challenge to Western sanctions enforcement and, financial dominance.
Okay, that's a lot happening with China.
Yeah.
Let's briefly touch on the S2 Underground report and other U.S. news.
Sure. The April 23rd Wire report from S2 mentioned a few things.
Like the Turkey earthquake.
Yeah, a 6.2 magnitude quake south of Istanbul, Constantinople. Limited reported damage initially.
And the India-Pakistan situation.
Deteriorating further after that Kashmir terror attack, India reportedly halted a water deal with Pakistan, paused a special visa program for Pakistanis entering Kashmir.
Increased security presence, too.
More Indian patrols near the attack site, high-level defense meetings, tensions definitely rising there.
And closer to home, the New Jersey wildfire.
Yes, large evacuations in Barnegat Township, the Jones Road fire in Greenwood Forest.
How big was it?
By that morning, about 8,500 acres, only 10% contained. Roughly 1,300 structures at risk, 3,000 people evacuated. A serious situation.
Okay. Did the S2 report comment on the U.S.-China trade war itself?
It did. An analyst, Thomas, noted the ongoing rhetoric, but said there were no real solid developments, just rumors and casual comments.
Pointed out the conflicting media stories.
Yeah, some saying Trump caved, others saying talks continue. He also highlighted the difficulty of a trade war with a communist system like China's, given the military angle in their economy.
But the conclusion was still leaning towards an eventual agreement.
Yes. Despite all the power projection, the analysts thought an agreement was still the most likely outcome down the line.
Okay, that perspective echoes some of the uncertainty we've been discussing.
Right. It reinforces that sense of ongoing flux, the complex mix of politics and economics.
So let's try to wrap this up for Thursday, April 24th. We've seen a global economy really feeling the pressure of U.S.-China tensions. The IMF warning about debt, slowing growth.
Europe, especially the UK, facing pretty stiff economic headwinds, while parts of Asia are, maybe surprisingly, showing more resilience.
And China itself is playing a complex game. Firm public stance, with signs of internal U.S. debate, strategic moves on rare earths, trying to mend fences with the EU, building alternative systems with Russia.
It's incredibly dynamic, and all these threads are connected. Trade tensions aren't happening in a vacuum. They're hitting economic performance, shifting alliances, even changing how global finance might work.
Which brings us to a final thought for you, our listeners, to maybe chew on.
Yeah, think about this. With the increasing use of economic leverage, like China using rare earth restrictions as a tool, how do you see global alliances and global supply chains actually changing in the next few years?
It's a huge question, right, with really significant implications for how the world works.
Definitely something to keep an eye on.
Indeed. Well, thank you for joining us for this deep dive. If you found this useful, please do consider liking, subscribing, maybe checking out our GoFundMe page.
Your support really does help us keep putting these together. Thanks for listening.